Very good evening and welcome. You're watching live session on the economic outlook for India, powered by Investonomics, an initiative by ICICI Securities. Those of you who are watching this live, please do subscribe to our YouTube channel. Also, if you want to post your queries in the comment section, we'll try and take some of your queries towards the end of this session. Joining me now is Mr. P.K. Basu, Chief Economist at ICICI Securities. Very good evening, Mr. Basu, and thank you so much for your time.
Good evening, Gitu.
Mr. Basu, let's start with the latest development that we had over the weekend, withdrawal of rupees 2,000 notes from the system. Any meaningful impact you see of this withdrawal on the economy, or do you see it as a positive for the banking system, which now will have ample liquidity in the system?
Well, no, I don't think it'll have too much of an impact on the broader economy because, interestingly, 2,000 rupee notes were last issued more than 4 years ago, almost 4.5 years ago. They were only issued for a very brief period, obviously, between November 2016 and no later than March 2019. And so they were not really in circulation. I mean, the number, the total value of 2,000 rupee notes in circulation was only about 3.16 trillion or lakh crores. And so there wasn't, I mean, I don't think the impact on the economy is going to be particularly significant. Most people who have 2,000 rupee notes can exchange them in the normal course in relatively small individual transactions of no more than 20,000 rupees at a time. So no more than 10 notes can be given to the bank at one time. But there appears to be no limit on how many transactions you do like that in a day. So you can do many more than one, it seems. So, I mean, there aren't too many real issues with this. The money that comes into the bank isn't going to help the bank that does the transaction very much, because they have to give other notes in exchange. So really, in terms of the money supply, no impact. In terms of the impact on the economy, very little, except that I presume that this is another measure that will reduce the amount of black money circulating in the system, simply because holding black money becomes more difficult. If you're going to hold it in 500 rupee notes, you have to have much larger numbers in order to hoard unaccounted for money. And so it, I think, if anything, is another blow against the black economy. But I don't think it'll have too much of an impact on the broad macroeconomy.
Is it also because we have general elections next year and we have state elections coming up that this kind of a step was really expected?
Not really. I mean, there was just a major state election in Karnataka. So if that was the purpose, then they should have withdrawn them just before, a few months before that state election. So I don't think it has anything to do with the election. Nothing very significant, except that, unless you assume that the ruling party has less black money or no black money and others have more. I mean, unless you make that assumption, I don't think there's really too much of an impact on, on electoral politics from this move. Although, of course, it's generated a lot of heat, a lot of political heat. I was on on several TV programs on Friday and Saturday discussing this, but I don't think it's really that much of an issue.
Let's come to the core issue which central bankers globally are facing, is the inflation. As far as the India CPI and WPI numbers are concerned, CPI inflation below 5%, WPI deflation, it's multi-month low as far as the WPI and CPI is concerned. So what is expected from the Reserve Bank of India in light of the data that we're getting as far as the economy is concerned?
I think what has become clear is that India has won its battle against inflation.
Mm-hmm.
The inflation fight in India was a little bit different uh, from that of the US in particular, or other Western countries, where there was too much monetary creation. There was too much money supply created during the COVID pandemic period. And the consequence of that is still being felt in the United States, Europe, etc. So in India, inflation was primarily supply driven. It was driven by high oil prices, India being a massive net importer of oil. In fact, not just oil prices, but if you look across the board, all commodity prices spiked between February 2022 and about July, August 2022. That actually caused a big spike in India's imports. In fact, I've just been looking at India's import numbers, and imports are now declining. You're seeing India's import numbers declining sharply in the last 3 or 4 months, and some investors are asking me, is this decline in imports a reflection of uh, a sharp decline in India's domestic demand, which often is the case when imports decline in any country. But in India's case, what's clear is that the decline in imports over the last 3 or 4 months is purely because of lower prices of imports. Imports of oil, oil prices, of course, are down sharply. Prices of coal are down sharply. Last year, India was importing a lot of coal, or seemed to be importing much more coal, but it was simply prices of coal had soared. Prices of oil, coal, palm oil, or other edible oils. These are significant imports for India. The prices of all these things had risen sharply. Now those prices have moderated. So our import prices are coming down, and so our import numbers are declining. The trade and current account balances are improving dramatically. Inflation is well in check. And so India is in a much better situation than most of the developed economies. So if you look at the developed economies, what you have is that the United States has raised its policy rate by 500 basis points, by 5 percentage points over the past 14 months. But its core PCE inflation rate is still 4.5%. It's well above the 2% target. You look at Europe, inflation at 7%, they are targeting 2% CPI inflation. So they are very far behind where they need to be. The UK is the worst half. It's got 10% inflation against its 2% target. So the Western world is still struggling with inflation. India has won its battle against inflation. And of course, WPI inflation is negative. So if anything, of course, WPI is heavily driven by commodities. And so commodity prices haven't come off. You're naturally seeing WPI inflation turn negative. So India has won its battle. I think there's no more rate hikes to come in India. If anything, the next move should be a rate cut. A rate cut, perhaps as soon as October.
As soon as October.
Yeah.
Can you hear me?
Okay. Rate cut in India.
Okay.
Yeah.
So do you see the improved macros for India percolate into a better micro over the next few months?
Well, the micro is quite good. I mean, if you look at corporate earnings, they continue to be quite strong. Especially when you compare India's earnings performance, India's corporate earnings performance over the last 3 or 4 months. You compare that to China. There was a lot of talk about this big China rebound.
Yes.
China had closed its economy off last year. In fact, April 2022 was when Shanghai was almost completely locked down. So the major financial center of China was locked down in April 2022. It was expected a year-on-year growth, but nothing of the sort happened. the numbers were well below expectations. The first quarter GDP was below expectations. And all this despite the fact that in China, total social financing increased at its fastest pace for the January to April period ever. So there's a huge increase in the amount of aggregate credit made available in the system in China, and yet corporate earnings growth has been dismal. By contrast, India has just been through its corporate earnings cycle. The numbers are good, broadly speaking. There are a few disappointments. I think Infosys and a few others have disappointed, but broadly, for most, I can cite a few like Coal India, spectacular earnings. State Bank of India, spectacular earnings. So there's been a really strong corporate earnings cycle come through. So the macro and the micro are in sync. They're both suggesting that the Indian economy is robust and is going to continue to outperform.
So what about the Fed this time? Do you expect Fed to continue increasing rates going forward? Because fight against inflation seems to be long for developed nations.
Well, I think the Fed is looking for an excuse not to raise rates at its next meeting. They're trying desperately. They're clutching at every straw possible. And we just had a comment from Chairman Jay Powell hinting at the possibility of a pause in June. I think it is highly unlikely that they can pause. There are two data points that are still to come before the next meeting. One is the core PCE inflation number towards the end of this month. And then around the 10th of June, just before the next FOMC meeting, you'll get the core CPI inflation. Now, suddenly, the media in the US has started focusing on headline CPI inflation. Headline CPI inflation is irrelevant. Of course, headline CPI inflation is going to keep moderating because oil prices are coming off. But in India, the RBI targets headline inflation, as does the European Central Bank. ECB also targets headline CPI inflation. In the US, the target is not headline, it is core. Now, if the central bank is targeting core PCE inflation, and that core PCE inflation is above 4%, then I don't see how the Fed can pause at its June meeting. So my view at the moment is that the Fed will hike again at its June meeting. And it simply cannot ignore inflation being that high. And it cannot suddenly say that, well, now we're not targeting core, we're looking at headline inflation. That is not the way a central bank functions. So, of course, there's also the argument that that monetary policy acts with a lag. Absolutely true. Monetary policy does act with a lag. There's a lag of perhaps 12 to 18 months between monetary actions and their inflationary consequences. That is a slightly better argument, but given where inflation is, and in particular, given the fact that month-on-month change in the core PCE has so far run at an annualized pace of 4.7% this year, I don't think it's possible for the Fed to pause.
If that's the case, sir, lately we have seen FIs turning back to India in terms of investment. Can we see the flight of capital again happening then?
Flight from or to?
Flight India. From India, yeah.
I don't see how we can. There should be no flight from India. There'll be a flight to India because even if the US raises one more time, the simple fact is that returns on equities in India are likely to be stronger because the economy is stronger. Now, if the US is to pause, if the Fed is to pause, one of the reasons why it will be pausing is because recession is beginning to set in. So when you have recession, earnings growth is going to be much weaker. So the next, the June meeting of the FOMC is either going to see the last rate hike of this cycle. That actually is pretty bad news for the economy, because it suggests that the economy is much closer to recession than the markets have let on so far. And in fact, if you look at the first quarter GDP numbers in the US GDP was up only 1%, quarter on quarter, seasonally adjusted. But within that, the growth came primarily from private consumption, which was up 3.7%. But investment spending in the US declined more than 10%. So if investment is declining 10%, all you need is a further, just a moderation in the pace of private consumption. Private consumption decelerates from 3.7 to say 2.5%. You'll get a quarter of negative growth, and that's the beginning of recession. So I think the US is close to recession. With the economy close to recession, it's difficult for corporate earnings to continue to perform. So I don't think there's going to be any sort of huge flow of liquidity back into the US markets, especially from India. I mean, if you look at other emerging markets, the main other emerging market that otherwise could have attracted flows would have been China. But there's no real recovery in the Chinese economy. Given that fact, I think the prospect is for India to continue to attract at least modest flows. Obviously, India's valuations are a little bit stretched, as they almost always are relative to other emerging markets. But increasingly, investors are beginning to recognize that those slightly stretched valuations reflect substantially better growth prospects.
As you said, sir, recession is setting in US. So can we expect crude to fall further, or we expect it to be around the same levels of $70-$75 per barrel?
Well, I think that crude is going to stay pretty soft. I doubt that crude is going to rise much above $85 a barrel over the next 6 months, even with restrictions on supply from the OPEC plus. So I think the likely range is $70 to $85 a barrel. And we are basically at the more or less the midpoint of that range at the moment, which is, very good news either way. Even if it goes to $85 a barrel, that would mean a 20% year-on-year decline in oil price for India over the first half of the fiscal year 24. So I'm looking at the current account deficit for India declining this fiscal year to 0.3% of GDP, assuming $85 a barrel for the full year. If oil prices come down and stay at the levels of around $75 a barrel for the rest of the year, then India could have a small current account surplus. So the external liquidity position is really strong. Current account deficit of just 0.3 is fully funded by FDI inflows, which typically are 1.5% to 2% of GDP. Net FDI inflow into India is around 1.5% to 2% of GDP. So FDI alone is fully funding small current account deficit. On top of that, as we just discussed, portfolio inflows, foreign institutional investors are continuing to look positively at the Indian market. So there'll be ample liquidity. And I think in addition, the strong domestic economy is going to ensure continued strength in government revenue. Government tax revenue continues to stay strong, and with that, the fiscal deficit comes out and helps to fund stronger investment spending. So you get a crowding in of private investment, and that helps the Indian economy to perform a lot better than most forecasts currently expect. I think, and if you look at the IMF, IMF is looking at 5.9% real GDP growth this year. I am forecasting 7.2%.
And what about the fiscal deficit level that you see for India in FY24?
So, yeah, the fiscal deficit, I think, will be 5.5% of GDP or less. Now, the RBI has just announced its dividend policy for the year. It's announced a big increase in profits. It has increased the amount of surplus that it'll hold on. But despite that, it's been able to pay a much larger 87,000 plus crore dividend to the government relative to the budget target of 48,000 crores. Now, that is possible because in the past year, the rupee has depreciated against the dollar. Dollar interest rates have gone up. So if you look at the asset side of any central bank balance sheet, the largest asset is foreign currency assets. Net foreign assets are a big asset item. On the liability side of all central banks, the main liability is note issuance. And when a bank takes in deposits, the bank must pay interest on the deposits, most of them. So deposits have a cost for commercial banks. But for the central bank, its main liability is notes and issuance. And notes have no cost. I mean, they just have a small cost called seniorage, but there's no interest payment that the RBI has to make. It makes a small interest payment on reserves held with it, but not on any of the currency notes. So since liabilities have no interest, the major liability has no interest, but net foreign assets, you're earning interest, and earlier you were earning very little, but now you're earning more. Interest rates have gone up almost everywhere around the world. The rupee has depreciated against most currencies. So in rupee terms, the asset side, the foreign asset side, has earned a lot. They've earned 10, 12, 13, 14%. And they've also done some sales. So when they sell foreign currency, they book some profit there too. So, but the basic point is just on the pure asset liability management, the interest income on the assets is much larger than the interest paid out, almost no interest paid out on the liabilities. And so the RBI has made a very comfortable profit and is able to pay out a dividend, larger dividend to the government. So that alone adds 0.2% of GDP to revenues for the government. So, unless the government finds new things to spend on, the fiscal deficit will be not 5.5% of GDP as I was expecting, but 5.3. So we're already looking at potentially a deficit closer to 5 than 6% of GDP. The target, of course, is 5.9. The number would be, I think, somewhere closer to 5% of GDP. Now, of course, 5% of GDP is nothing to crow about. It's nothing to celebrate. It's still a large number. We would prefer to see a deficit closer to 3% of GDP. But at least India is getting back onto the glide path towards that 3% target. And for that, this government deserves some kudos because this has been a difficult period for the global economy. Most other countries have seen a big run-up in their public debt. And as you know, in the US, we have a very serious problem with the debt ceiling becoming a major issue that is being discussed between the president and Congress. And all of that is happening because during the COVID period, and actually in the US, ever since 2009, fiscal deficits have been very large. And the fiscal deficit, the 4-quarter moving average of the fiscal deficit in the US is 6.6% of GDP as of March. the public debt is 123% of GDP in the US. Those are massive numbers. Anything above 60% used to be considered too high. The US has had double that level. So these countries are facing a much bigger challenge. India has a relative luxury of seeing its fiscal deficit coming down, coming well under control. And India can now get back onto the glide path towards that 3% target over the next 2 or 3 years.
You just raised the issue of debt ceiling in US, which is keeping the world markets on the edge. I mean, this drama is happening from last a few weeks. Do you see this ending soon?
It has to end on the 1st of June. It better end on the 1st of June. If if we know what is good for us, and if the US knows what's good for them. I think if you look back to 2011 and 2013, 2011 in particular, when Barack Obama was in his 3rd year as president, he also was facing a hostile Congress, the almost exact analog of the current situation then. And what happened then was that the US's sovereign rating was actually cut by Standard & Poor's, which is actually ridiculous because the world's reserve currency country has to be a AAA rated credit. If it isn't AAA, then it destabilizes markets a lot. But anyway, S&P reduced the sovereign rating for the US. That didn't last very long, but it happened. Now, but I think it's instructive to look at what happened in 2011 and 2013. Now, 2011, the Senate Majority Leader at that time had talked about wanting to make Barack Obama a one-term president, and they would do everything to make his life as bad as possible. Of course, House of Representatives controls the purse strings in the US, and the House of Representatives argued, negotiated, went to the brink, but at the last minute, just as the debt ceiling was about to be hit in August 2011, that time it was in August, this year happens to be in May, June, they came to an agreement. Now, the agreement requires compromises on both sides. Barack Obama agreed to cut some spending, substantial amounts of spending. US Congress agreed to raise some revenues, that is, increase some tax rates. And that process of negotiation went on. In 2013, Obama by then had already won a 2nd term. And this time, Congress didn't feel as much of a need to be tough on him, but they were tough on him. And in the end, a compromise was agreed. But the basic point is that the US has excessive debt. I go back to the late 1980s. During the Reagan years, fiscal deficits ran up very rapidly. But the deficit there, the public debt was then around 55 to 60% of GDP. They'd been going up a lot. They went from 40% to around 60% of GDP over that period. And people were really concerned. And a solution was eventually arrived at by about 1995 to 97. 1995, again, the Republicans were in control of Congress, led by Newt Gingrich, the Speaker of the House. Clinton was the Democratic president, and they came to a solution. They basically forced Clinton to come to a solution. And in the end, the last 2 years of the Clinton presidency, the US had fiscal surpluses. So I think that is the path that the US will get onto. But we are now at a difficult stage, early stage of the negotiations. These negotiations should have occurred 4 or 5 months ago. They're occurring now at the point of a gun. Biden should have been in Papua New Guinea today. Instead, he's on a flight back to Washington, D.C. And Papua New Guinean Prime Minister was very upset, but instead he's entertaining Prime Minister Modi and apparently getting along quite well. Now, but the point is that Papua New Guinea, I think, is actually strategically really important to the Quad. And it is a shame that the President of the United States couldn't go to Papua New Guinea, and instead he's headed back to the US. But I think, sometime around the 29th or 30th of May, some sort of solution will emerge. That's the nature of these negotiations. Both sides like to take things to the brink, but in the end, they'll come to an agreement. Kevin McCarthy and Joe Biden get along reasonably well, but actually that's truer of Mitch McConnell and Joe Biden. They've all known each other a long time. Personally, they're quite friendly. So that, I think, helps to smooth things and make progress. But both sides are going to argue hard. They're going to bash each other publicly a lot, and eventually hammer out a solution. Hammer out is, the pun is very much intended.
Let's come back to our, Indian economy. The kind of GDP that you're targeting for FY24. So, what is really going to drive the growth from here?
Yeah, what's going to drive it is investment spending. For me, the evidence that investment spending is still growing is there in our capital goods output numbers. Capital goods output grew nearly 10% in fiscal year 23. Capital goods imports grew nearly 14%, and capital goods imports continue to grow. So if you look at I talked about imports declining. Interestingly, India's imports are declining, but machinery imports are growing strongly in double digits. So machinery imports are growing, capital goods output is growing, which tells us that investment spending is coming through. And if investment spending is coming through, that will be an important driver. Now, the second factor that will help is net exports. I'm looking at the current account deficit going from 1.8% of GDP this year to 0.3. I mean, 1.8% of GDP in FY23 to 0.3% of GDP in FY24. So, 1.5 percentage points of GDP worth of improvement in the current account. So net exports contribute. Of course, some of that contribution comes from so-called improvement in terms of trade. Your export prices do better than import prices. But an improvement in terms of trade is like a tax cut to the domestic economy, because things that you have to buy, oil, as long as you own a motorcycle or a car, you have no option but to keep putting petrol or diesel or natural gas, LNG into it, whatever the vehicle. So you have to do that. You have to buy it. But if the price of that comes down for no reason, for no apparent reason apart from global factors, that's a pure benefit. And that pure benefit means that, in effect, households and businesses get a boost to their net incomes. And that improvement in net income contributes to an improvement in consumption. So that, coupled with the fact that at least in the first half of the monsoons, we are unlikely to get any real impact of the El Nino, means that, first of all, the Rabi crop was very strong. Now the early part of the monsoons should be good as well. And I think, if you live in North India, almost every night it's raining, which suggests that if anything, the monsoons may be early this year. And of course, both Skynet and the IMD are looking at perhaps even a bit of a delay in the monsoons coming in from Kerala. The rain that we are seeing in North India is clearly pre-monsoon showers, but quite substantial showers, unusually substantial showers, which is all good news, I think, for the Kharif crop this year and the sowing season. So the Rabi was strong, most likely. Kharif will be good. So private consumption should get a boost. I mean, domestic rural consumption should be reasonably strong until we begin to see some sort of El Nino impact. So all of that, I mean, primarily investment spending, net exports, and a little bit of help from private consumption. And some of that private consumption help, of course, comes from the terms of trade improvement, which acts as a boost to net incomes for households and businesses.
Mr. Basu, our manufacturing sector still
look at
lags.
Coal prices down, oil prices down, edible oil prices down. You look across the board. I mean, I was actually looking at prices. I was trying to notice why our imports are down, and it's primarily because prices are down, and prices are down sharply from unusually high levels last year. So the fact that the Indian economy likely grew more than 7% in FY23, despite this deterioration in the terms of trade last year, with our import prices rising a lot, is, I think, another piece of evidence of the resilience of the Indian economy.
One of the sectors which we often talk about is manufacturing sector, but that sector is still lagging behind. I mean, if we talk about exports from India, manufacturing sector has to do well if we have to really have that chunk of exports in the global trade. What exactly needs to be done, Mr. Basu? Because we have been trying a lot. We had PLI schemes, we had everything happening to help the industry grow, but the results are not seen on ground.
Well, I think that there are some results. I mean, electronics have done remarkably well. Chemical exports have done well over the past 9 years. And auto component and car exports have done well. So there are about 4 or 5 areas of really strong export performance over the last 9 years. Over the last, even over recent years, there's been pretty decent performance. Now, the last 4 or 5 months have been difficult. In terms of engineering goods, if you look at, the primary area of engineering goods that is suffering in terms of exports is steel and aluminum, basic metals, basically, primarily because of the export duties that were imposed last year. Petroleum products also still suffering an export duty. There's an export duty on diesel. So with those exceptions, and of course, the one area that I keep harping on is the lack of any improvement in labor-intensive manufacturing and exports. So labor-intensive manufacturing and exports needs attention. The labor reforms passed by the government and signed by the president almost 3 years ago need to be notified. A number of states have started notifying them, but if they get notified and you begin to see actual implementation of those new labor laws, then I think labor-intensive manufacturing too will pick up. And if labor-intensive manufacturing takes off in India, then 7% growth will be peanuts. We'll be doing 10% growth annually, because that is where you can employ hundreds of millions of people who can move from low marginal productivity jobs in agriculture to much higher average productivity jobs in manufacturing. Even basic manufacturing the average productivity is substantially higher than average productivity in agriculture, and certainly marginal productivity in agriculture. The last person that you move out, the productivity is very low. So if you can move people away from agriculture through much higher average productivity jobs and therefore higher paying jobs in manufacturing, that'll lift the entire economy. At the moment, we're seeing most of this occurring really in the electronic space. We can see that Apple, for instance, Apple and the ecosystem of Apple's suppliers are beginning to move substantial parts of their manufacturing to India. Now, we're looking at perhaps a quarter of iPhone 14s being manufactured in India by 2025 or 2026. That would be a big, big shift. It will be transformative. But if we can get even 1/3 of the amount of textiles and garments exported from China to move to India over the next 5 years, that'll triple the amount of textile and garment manufacturing India can do. Textile and garment exports India can do. So that is the area that is the sort of unplucked low-hanging fruit. If we can start plucking that low-hanging fruit, then we can get to 10% real GDP growth.
Mr. Yusuf, we have a couple of questions which have come on the YouTube. We try and take some few of them. It's Mr. Arun Agarwal has sent a question. Long-term impact of various PLI schemes.
The PLI schemes, I think, have had varied impact. In order to obtain any PLI funds, any manufacturer has to meet a production growth, an output growth target. So in most cases, it's an increase of 6% on previous year's output. In some cases, it's 7, 8, and so on. Many of those who put their hands up and said, we want to participate in the PLI scheme, fail to meet the targets. If you fail to meet the target, you don't get the subsidy payment. I mean, you don't get the incentive payment. And there have been a number of reports of so-called recipients not getting them. So I think the PLI schemes have had mixed results so far, but the government is continuing to fine-tune them, is continuing to extend PLI incentives to different sectors. And from an economic standpoint, it goes against economic, free market ideology and logic. But we are competing against China, not just us. The whole world is having to deal with a non-market economy that provides incentives that are much larger than what we are providing or what the United States under Biden is now providing. So these sorts of incentives are required as a way of countering the humongous, almost unlimited subsidies that state-owned and state-linked companies in China receive. And that is why we need to keep this going. Now, the interesting thing about India's PLI schemes is that they're not going to last forever. The idea is to induce a big step up in production. And once that step up in production occurs, then scale economies begin to be achieved. And once scale economies are achieved, the unit cost of production comes down, and you don't need the incentive anymore. That is the theory. But I would say that the results are very mixed, and we are still at a very early stage. And if anything, the last 1 year is the first full year of the PLI being in place. The next couple of years are really going to be important.
Vela has a question for you. He says, rate cut in India when US is rising and not cutting. What is expected of rupee versus dollar? What happens next?
Okay. Well, I think the if you notice, the rupee has been more or less stable against the dollar since November. And the dollar itself has been weakening against most other currencies. So I think this is a very clever policy that India is pursuing of keeping the rupee basically stable against the dollar, which itself is weakening against the euro, the pound, etc. I feel sorry for the Brits. I mean, they have a very strong pound because their interest rates are going to have to go up the most. It's not a good reason to have a strong currency. Your interest rates are having to go up because the inflation is too high, and so your currency is strong. Now, I think the rupee is going to stay relatively stable against the US dollar, but will be depreciating against euro, sterling, and a few Asian currencies. You'll notice that the Chinese renminbi has started to weaken over the last 6 weeks, 6 to 8 weeks. It's more or less moving in tandem with the rupee, or slightly weaker. So we have a situation where the rupee is depreciating a bit against its trade-weighted basket, and that I think is going to give a little bit of a boost to our export sector. The other thing that is worth noting is, of course, that our services exports continue to be very strong. I think there is a long-term phenomenon here of a shift of data center businesses to India. There's a lot of data center businesses moving to India. There's a lot of consulting work that is moving to India, not just with Indian companies, but also with some foreign consulting firms doing much more work in India. So services exports are strong, and all of that is contributing to a much better situation for the Indian economy.
Katish has a question. Share the data. What imports are declining and why?
So as I said, I mean, imports of oil are declining the most. And oil is around 29% of our total imports. So if oil declines, then you get, that's a big chunk. Coal imports are declining. These are declining in value, right? Primarily because prices have come off. And edible oil imports are declining. So these are three major areas of imports that are declining, almost all because of lower prices. Now, other imports that are declining, interestingly, the latest couple of months, electronics imports have declined. Now, electronics imports have declined, I think, primarily because domestic production of electronics is being ramped up, and the ramp up of domestic production is helping to substitute some imports with domestic production. So exports of electronics are doing well. Imports are declining. That's really quite good news. Similarly, chemicals. You're seeing chemical exports also doing well. Chemical imports declining. So those are two areas where India is successfully replacing imports with domestic production. Now, there was a good question and discussion earlier about, as Geetu, in fact, mentioned, the industrial production numbers are not showing some of the strength that I'm talking about. That is unfortunately because we have a fixed index number series for industrial production. So the weight for the new electronics items that are being produced in India is probably infinitesimal. It's very tiny. It's probably, in 2011-12, the base year, there was almost no production of smartphones. Smartphones probably didn't even exist, and in terms of production in India, it was minimal. So the weight for smartphones in the electronics, in the electronic component segment of the IPI is almost zero. The weight is negligible. But if that thing is growing a lot, it doesn't show up as growth in electronics. In fact, you look at the electronics numbers, our electronics output is down. That probably is because there's obsolescence. Some of the elements of electronics that had a high weight in 2011 are not being produced anywhere in the world, not in India either anymore. So their production is going down, and seems to be that there's no electronics growth. So these are problems, statistical problems with index number series that occur everywhere. Some, in the US, they've come up with a solution called chain linked series instead of fixed index number series. In China, they don't even have in China, the methods are very unique. So they just go overcome these problems with other tricks. But they start every year with 100. There's no index number. It starts with 100, and everything is 100, and then at the end of the year you reach 110 or 106, and then next year again start at 100, which actually is an interesting way of doing it. So you have a different index each year. Now, India has a 2011-12 fixed weight industrial production index. And given the amount of change in the economy, we are probably underestimating many parts of the actual growth that is occurring, especially in industry.
Samar Mandal has a question. Where is banking sector going in view of the future interest rates?
Well, I think the banking sector is in very good shape. If you look at the corporate earnings by the banks, both private sector banks as well as the state-owned banks, most of them have done really well. They've all come up with very strong earnings performance, and so I think with stability in the interest rate environment over the next few months, banks will be in even better shape.
One more question is from R. Chandrasekhar. Why API sector is going down?
You mean pharmaceuticals?
Yes.
Yeah, well, I mean, pharmaceuticals, I mean, essentially, we import a lot of our APIs from China, and so does the rest of the world. I think what you're talking about is actual equity market performance. If you look at pharmaceutical exports, they're actually doing rather well. But equity markets, I mean, sometimes you get valuation issues when a particular sector does very well in the equity market for some time. Then it typically goes through a period of underperformance for the next few months. So that's part of what is called a sector rotation in the equity market. But I think if you look at the fundamentals of the pharmaceutical sector in India, they're sound. APIs, unfortunately, we haven't successfully substituted the imports that we get from China. But I think APIs are going to be receiving some PLIs, production linked incentives, over the next few years, and they will start benefiting from that, and we'll begin to see a longer term shift, or longer term increase in our production.
Katish has one more question. Oil prices down sharply. Yes, petrol, palm oil, gas, all coming down in India. We all pay less on all of this. What is expected?
What is expected is slightly lower prices going forward as well. And I think what I would emphasize, I mean, what this government has done, which is a little different from past governments, is that it hasn't passed on all the benefits of a lower international oil price to the consumer. because there is a long-term focus on shifting consumers away from carbon fuels to renewables. So unfortunately, even with renewables, there's a challenge. I mean, so if you want to get into solar, for instance, India is now the second biggest producer of solar energy in the world. But we are way behind the biggest, China. And we're also way behind China in producing solar panels, the photovoltaic cells, etc., for solar panels. Ironically, this is actually something that requires components that are very similar to semiconductors. So if we are going to be a successful producer of photovoltaic cells, then we need to have a semiconductor industry. And that is why there is such a lot of focus by this government on not only boosting electronics in general, but quite specifically boosting the semiconductor sector, which actually is a non-existent sector in India. Semiconductors are extremely capital intensive, but Ashwini Vaishnav, our minister in charge of that area, has just spent a week in Silicon Valley in California trying to drum up interest. Hopefully, we'll begin to see significant investments in this area. We've, of course, got talk of Micron Technologies of the US looking at India as a possibility, especially because China is making life very difficult for that company in China itself. So I think we can try to encourage the likes of Samsung Electronics, which is the world's largest producer of dynamic random access memory chips, to not only do smartphone manufacturing in India, but also do some DRAMs. Maybe, so the idea is that we are going to have to incentivize more companies to come to India and produce semiconductors, related technologies like solar panels, all of which, unfortunately, many of these areas, China is the dominant player. But in semiconductors, China is very far from dominant. The dominant player is Taiwan. So we need to try and befriend Taiwan. Taiwan, of course, has an election coming up where the pro-mainland China party is trying to put up a candidate who will somehow appeal to the domestic electorate, but also be friendly to mainland China. So these are difficult developments, but we need to befriend Taiwan in particular, and embrace, not just befriend, embrace Taiwan. Taiwan and India have a lot in common, both strategically and culturally. Taiwan is a majority Buddhist country. They have a lot of links to the Dalai Lama. So we need to encourage these things and encourage that relationship with Taiwan and South Korea, and encourage their big successful chip manufacturers to relocate at least small parts of their manufacturing in India, and then do more with photovoltaic cells and solar panels.
So now it's time to wrap up. Thank you, Mr. Basu, for being with us, and I appreciate your time, sir.
Thank you so much. Thanks for your time, Geetu. Thank you.
I also would request my viewers to really subscribe to our YouTube channel. And also, if you have any questions, please do post the questions in the comment section. We'll try and take it in our next program. Also, if you have any specific topics that you want us to cover, we'll please post them in the comment section. We'll try and address that and try to discuss the topics that you would have suggested us. Thank you so much for watching.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.